All right. First of all, thank you for the invitation. My name is Anthony Cohen. I'm in Singapore with CQG, and I'll be spending the next few minutes talking about arbitrage opportunities for QFI participants. Briefly about the content of the next few slides. We're going to be talking about energy, part of the FX hedge that's quite important with all this process. Then we have non-ferrous metals, commodities, precious metals, and non-agricultural products. The first product and strategy that we're going to be looking at is really the crude oil. It's as we heard earlier, one of the very popular one. It's involving the ICE Brent and the sour crude on INE. As we can see here, there's obviously quite a large positive correlation there. And since the market is actually closed, we're going to be showing a recorded version of it. But just to show you that this spread is quite straightforward. The contracts are of the same size, and the only sort of requirement is the FX hedging. So it's really a one-to-one between the two products. And we're seeing here that the two products are about $85,000 in terms of contract value. And this kind of requires FX hedging to be of a similar contract size. And from the very beginning, the exchanges such as SGX and HKFE or HKEX were offering contracts of about $100,000 of value. But since the launch of these INE contracts, new products and mini contracts have been made available by those exchanges, HKEX and SGX, as well as the ICE and others like Apex. But I've decided to give you an overview of the most liquid ones. And the reason why this is important is because if we look at the earlier spread, $85,000 in terms of contract value can be a little bit under the contract size of a futures contract for USD CNH. So using a 1-to-1-to-1, so meaning one contract on the SGX full size of $100,000, means that we can actually be a little bit overhedged on the currency side. So you can either use one big contract and be a little bit overhedged, or 4 mini contracts on HKFE and be a little bit underhedged. As we can see here, this is an overview of, this is an aggregated view of those contracts. And we can see that this is going to be quite important for the next slides. We can see that the columns closest to the actual price would be the big contract. So this is the big SGX FX and the big HKFE bids, and these are the offers. We can see the spread is quite tight for these products, and the ones on the outer sides, outer columns, would be the mini contracts, and we can see that the spread is not as tight. So there's going to be a benefit from using the larger contracts to hedge in terms of pricing, but there's also a benefit from using the smaller size contract in terms of contract value. So the next strategy would be the copper one. Copper can be found in various exchanges outside of China to be used for arbitrage purposes. We have the copper on the LME, which is represented there in white, and the red one would be the INE bonded copper. We can see the contract values over there. So really this would be a 1 to 5 relationship ratio. So 5 INE for 1 lot of LME. We can see that there's obviously a very high correlation on both the daily and the intraday basis. So what does that do? We can do it a little bit differently on this side. So what we can do here is we can turn the LME contract into CNH, and this would be a ratio of 1 LME to 2 CNH on the SGX, which will bring it to around $200,000, and then spread that against the bonded copper on the INE, and we can see here the contracts working. So what we see here, and this is something I want to show, is that there is an importance in terms of contract size, and we can see that the liquidity in some of the products, so especially on the FX side. So if since we're requiring 2 lots of the SGX FX, if only 1 is available, we're not going to be quoting the bonded copper leg, because we're at a risk of getting legged out, meaning that there isn't enough liquidity on the FX side. So the system will basically stop quoting until the liquidity comes back on the leg that's not liquid enough. Just a quick one related to the specificity of the products traded in China, which is different than the ones in the rest of the world. For those who don't see that every day, there is obviously a way for the orders to be sent with different types of characteristics. So if you wanted to send it as an arbitrage order, a hedge order, then you can actually do it. You can do that at the order placement level, and you can also decide whether you want to have a long today, short today, long yesterday, short yesterday. So you will have split longs and shorts on those markets, but we can also allow for a netted version of it. So any long position today will be offset by a new short position and vice versa. So this is why there's a little bit of a difference on the bonded copper view. Copper can also be spreaded against the COMEX copper, that's CPE on this side. And we can see that this would be a ratio of about 2 to 1. And the correlation is a little bit lower than with the LME one, but still quite interesting to be traded. Next, we're going to iron ore. And iron ore is traded on various exchanges. So obviously we've got the INE side. The SGX one is a little bit more liquid than the one on HKEX, but there is something to do on the HKEX side as well. We can see that the contract values are pretty similar, but they're pretty low. And this is where the small size contracts will be handy. And we can see at the bottom here that we have the INE iron ore against a mini contract on the HKFE, which is about $20,000 worth of contract value. And this is why we have a 2 to 1 ratio. And then spreading that against the FEF, which is the SGX iron ore. That can be done a little bit differently because we can see that the SGX mini contracts is actually a little bit more liquid than the HKEX one when it comes to the FX futures. So you could use the SGX mini contract, but be a little bit overhedged in terms of of FX, or increase the quantities in the iron ore contracts and use the big contract on the SGX FX. So it's basically a give and take. It's either you're using more quantities on the iron ore or a smaller contract on the FX side, but risk a bigger spread. Zinc is one of the last ones that we're going to be looking at, and zinc is one of those that can be traded against LME. The contract sizes are 5 to 25, so it's really a 1-to-5 ratio between LME and the Shanghai zinc. And another one that's a little bit less liquid, but still quite interesting. It's one of the two contracts that we'll be looking at on the HKEX. So the HKEX actually lists two contracts when it comes to mini zinc. You have a USD denominated one, which is the one that we're looking at right now. And we can see that there is actually something going on, and you can see that the orders that we generate are pretty close to the market. And there's also, and this is one of the other sort of alternatives and the sort of new opportunities that this is going to create. The HKEX also has a CNH denominated mini contract, which doesn't trade a lot anymore. It used to trade a little bit in the past. I'm pretty sure that they're still listed and they're not planning on delisting them. But the advantage of that is that for market makers who want to start, being active on those markets, it's an advantage because there is no longer a need for a FX futures leg to quote that. So it's really a one-to-one straight from the Shanghai to the HKEX. TSR20 is an interesting one as well. We can see that this is a fairly straight forward ratio as well. 10 tons for ANE against 5 tons on SGX. There is a quite a high correlation between the two. We can see that mostly on the fairly low number of bars. And then here we can see that this is quite an active market on both. There's a little bit more liquidity on the INE side. So actually this can be used to quote the SGX and complete the spread onto the NR side. Gold and silver are obviously, pretty large contracts on both exchanges. So there's obviously gold and silver are extremely liquid products on the COMEX, the CME, and so that's kind of an easy one to look at. But I wanted to go through a slightly different way, and again a little bit similar to the previous contracts that we saw on zinc. There is an alternative on the HKEX, which lists some CNH products. So the gold and the silver products are tradable on the HKEX. They are not very active either, but again, it is a huge advantage for market makers who want to use the Chinese products to quote the HKEX side in a very easy manner. Lastly, we have PTA. So this is something that we talked about a couple of years ago when this was made available. It's slightly more deviated and not as straightforward spread or arbitrage opportunity, but it is still there. So PTA is obviously part of a process that comes from crude oil. So there's a transformation process, turning it all into naphtha, PX, PTA, and then PET. I'll spare you the complexity of the words, but basically there is a high relationship between crude oil and PTA due to the transformation process. There is actually a PX futures contract on the SGX, but it's not liquid at all. So there is not much to do on this one, but the obvious liquidity, high liquidity on the crude oil and the liquidity on the PTA makes it an interesting arbitrage. We can see here that so the arbitrage is not obviously a a one-to-one basis, and this is why the correlation is a little bit lower when we look at the crude oil on NYMEX and the PTA into US dollars. So we can see that over 2 or 3 bars, it's quite interesting. But the more interesting is if you look at them on an average basis, and you can see that the correlation is a little bit smoother there. And the execution ratio, what we had previously was a 16:1 to do that. So it's 16 PTA in USD against 1 crude. And we can see that there is enough of the correlation to make it interesting. So I hope you found something interesting in this, and this will conclude my session. Any questions you may have, just don't hesitate to email us and find more information on cqg.com, and I'll pass it back to the host. Thank you.